Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, let's start with the big picture. What was the main market story this week?
The big story is that Gulf risk is back in the inflation price. For a brief moment, markets wanted to believe that the situation around Iran and the Strait of Hormuz was calming down. Oil prices pulled back, equities rallied, and investors started to price in a cleaner disinflation story again. But that relief trade did not last. Brent is back around $101 a barrel, WTI is near $96, and the market is being reminded that this is not just a spot oil shock. The longer Hormuz remains disrupted, the more this becomes a broader inflation problem. Oil feeds into freight, it feeds into insurance, it feeds into refined products, chemicals, fertilizers, and food inputs. So this is not just about what happens at the petrol pump. It is about the cost structure of the global economy. And I think markets need to stop treating every peace headline as a clean disinflation signal.
So, oil is becoming the transmission channel again?
Exactly. Oil is the way geopolitics becomes economics. And what is interesting is that the US is feeling this more visibly than many other regions. US petrol prices are rising faster because there is less tax cushioning in the pump price. In Europe, taxes make up a much larger, fixed share of fuel costs, so a jump in crude gets diluted before it reaches consumers. In the US, lower fuel taxes mean the oil move passes through much more directly, and American households are also more car dependent, so demand does not adjust quickly. That combination matters: low tax buffer, high car dependency, and a direct hit to disposable income. So when oil rises, it acts like a consumer tax. And that is why this is not just an energy story. It is a growth story, an inflation story, and a central bank story.
What does the latest macro data tell us?
The US data still does not give the Fed much room to look through the shock. Initial jobless claims rose to 200,000, but that was still below expectations. Continuing claims fell to 1.766 million. So the labor market is not breaking. Layoffs remain low. That makes the payrolls report more important than usual. In a normal environment, a softer jobs number might help bonds and support the case for rate cuts. But in an oil shock, weak growth and higher inflation can reinforce the stagflation trade instead. That is the uncomfortable mix. Growth may be cooling, but inflation risk is rising from the supply side. Europe looks even more fragile. Retail sales fell 0.1% in March, and fuel sales were down 1.6%. That tells you households are already changing behavior because of energy costs. So the consumer squeeze is real. It is just showing up differently across regions.
And what are central banks doing with that?
They are becoming more cautious, and in some places, more hawkish. Fed speakers are still trying to avoid overreacting. Mary Daly said, inflation expectations are not yet showing a durable energy pass-through. But Beth Hammack was more direct, saying rates may need to stay on hold for quite some time. That is really the key point. Even if the Fed does not hike, it may not be able to cut. In Europe, the tone is arguably even more hawkish. Isabel Schnabel linked the Iran war and energy prices directly to upside inflation risks and warned against waiting for second-round effects. And then Norway actually raised rates. Norges Bank lifted its policy rate by 25 basis points to 4.25%, citing inflation that is still too high and the added risk from oil and the Middle East. Sweden, by contrast, held rates steady. So we are no longer in a simple global easing cycle. We are in a fragmented central bank world. Some are on hold, some are still tightening, and almost everyone is being forced to take energy inflation seriously again.
How are equity markets dealing with this?
Equities are bending, not breaking. The S&P 500 was fractionally lower. The Nasdaq also eased. Asia was softer this morning, and European futures were under pressure. But risk appetite has not collapsed, because the AI story is still powerful. That is the tension in markets right now. Oil keeps interrupting the macro narrative, but AI keeps supporting earnings and sentiment. Semiconductors, data centers, power infrastructure, cooling systems, memory, copper. These are still areas where capital expenditure is real and earnings momentum is strong. So the market is not saying sell everything, it is saying be selective. The companies linked to scarce capacity and real investment cycles can still do well. But the companies that need cheap money, cheap energy, and smooth supply chains are in a much harder position.
What about currencies? The dollar seems to be holding up.
Yes, but the reason is changing. Dollar support is becoming more oil-linked. It is less about pure U.S. growth exceptionalism and more about risk aversion and the inflation premium. Asian currencies are feeling that most directly. The Indian rupee had a short rebound, but that may fade if higher crude prices revive dollar demand from oil refiners. Singapore dollar and Korean won also softened. The yen is the more important macro signal. Japan appears to be defending the 160 level against the dollar, which tells you imported inflation is becoming politically intolerable. But intervention can only slow depreciation. It cannot reverse the underlying pressure if Japan still has weak real rates, high energy import dependence, and loose fiscal policy. So FX is becoming part of the inflation toolkit. Central banks are no longer just watching currencies, they are responding to them.
You also mentioned credit. Are we seeing stress there yet?
Not broad stress yet. Credit spreads are still relatively calm, but that does not mean there is no risk. The warning signs are usually hidden before they become obvious. The Financial Stability Board recently warned about private credit, leverage, opacity, and links to the banking system. The sector is now estimated at roughly $1.5 to $2 trillion in assets. Oil shocks do not hit weaker borrowers immediately through default data. They hit through working capital, transport costs, margin compression, and refinancing pressure. So the credit story is not accident today, it is fragility building beneath the surface. And that matters because calm spreads can create a false sense of security.
Corporate news this week also seemed to reinforce the macro picture. Maersk stood out.
Maersk was probably the cleanest corporate read-through this week. The company said the Iran war has added roughly $500 million a month to fuel costs. Now, higher freight rates are helping offset that for now. But Maersk also warned that inflation and weaker consumer demand may emerge later in the year. That is the transmission mechanism investors need to watch. First, companies pass through costs, then volumes weaken, then margins get questioned. That is how an oil shock moves from commodity markets into corporate earnings. And it is not just oil. Petrochemicals, fertilizers, naphtha, LPG, these are all part of the inflation chain. The World Bank expects energy prices to rise 24% this year, and fertilizer prices 31%. Frankly, given the scale of disruption, those numbers may prove conservative.
That's it for this week. Stay tuned for more insights next time.